Okay, I think in the interest of time, perhaps we kick off.
Started. Yeah, brilliant. Well, welcome everyone to the Carrington Market Insight webinar, the first one of 2021, and it's good to see so many of you joining, and Happy New Year to you all. This webinar, we're going to be recapping 2020 on what was quite an eventful year, and also an outlook on 2021, and including specific sectors that are of interest to us at Carrington. For those of you who haven't met me before, my name's Tommy. I joined Carrington in July, and I've been working alongside the planning team on the client relationship side, but also helping Mo on the investment side, looking at fund research specifically. So without further ado, I'll pass you over to Mo, who's going to start with a recap of 2020. Just quickly, at the end of the webinar, we're going to be doing a Q&A as well, but feel free to put in any questions you want throughout the webinar, and then we'll answer them at the end of the presentation once Mo's finished. So, Mo, over to you.
Great, thank you. Hello, everyone. Lovely to see all of you. Just a quick one to follow up on the Q&A. The actual box or option to submit your questions, you can either find at the bottom of your screen or the top of your screen. For some people, it's finds itself at the top. But right, we're just going to quickly share my screen. There we go. Right, so welcome everyone to our first Market Insights webinar for 2021. Right, yeah, so there we go. So we're going to be covering off, as Tommy mentioned, a recap of 2020. We're going to be looking at the potential containment of the COVID-19 pandemic. We will touch on ESG factors, otherwise known as environmental, social, and corporate governance. We'll move on to key themes that we feel will be important for 2021, followed by a summary of our thoughts. So, 2020, I think from an economics perspective, it really does depend on what sector you were operating in. For some, it turned out to be quite a good year, and for others, clearly, a very poor year and one to forget. The year was marked by a number of milestones, and I think one to perhaps point out was that we saw the fastest recession and then subsequent fastest recovery in history, both of which occurred during the year. The year, I think, was characterized by a lot of price extremes in a number of different sectors. So, for example, those that benefited during the pandemic, such as mobile payments or online shopping, clearly were winners, and their share prices of those companies went up significantly. And on the flip side, sectors such as energy, airlines, for example, did very poorly, as was no surprise, and share prices suffered significantly. During all of that, we had a presidential election over in the US, and obviously you all know that Joe Biden went on to win that. That, I think, will have some implications in the years to come. And finally, the UK at last made a deal with the EU. I think we're all quite relieved to have seen that, and that ends a number of years of uncertainty. So we can sort of look forward to the UK now moving forward in terms of its growth and prospects. And obviously there's a lot of grey areas in terms of what that actually means. I don't think we're exactly clear, but nonetheless, I think a lot of uncertainty has been removed, and so perhaps that's quite a positive for the UK in the years ahead. So the containment of COVID, I think, now looks likely for this year. If we think about when the actual pandemic emerged back in sort of February, March time of last year, within 8 months, 9 months or so, we had a highly effective vaccines developed by several different companies, which I think is quite an astonishing achievement. And it just goes to show the advances that have been made in the healthcare sector. And we will come on to this a bit later on as one of our themes for 2021 and beyond. So again, you probably all know that governments across the world have begun various vaccination programs. In the UK, they have made some pretty positive steps already, and as of this morning, about 7% of the UK population has now been vaccinated. The majority of whom are in the vulnerable category, which is going very well. If you think about the US, they're probably more like 4% of the population. And then over in Europe, you're probably looking at something like 1 to 3%. So they are slightly slower at the moment. But all of these point to hopefully us seeing the back of this pandemic, or seeing it at some point, perhaps by the summer. As a result, I think the markets at the moment, despite the fact that, as we've noted in previous commentary, and I think in my last webinar, that the Northern Hemisphere will be in the winter period, and therefore we are likely to see the pandemic get worse, which I think clearly it has done. And so we're in the midst of a renewed wave. I think that's probably the worst one we've seen yet. Despite that, the markets have actually done relatively well, and remain buoyant and continue to grind higher. And I think it's because they are actually looking through this sort of short-term wave that we're in at the moment and focusing on the vaccine rollout and what the economic recovery could potentially look like later on this year. That also coupled with central banks, which are continuing with their stimulus programs, and they've made it very clear that they have no intention of backtracking on those for at least the next few years. So with those in mind, I think the markets are just looking through the current pandemic situation that we're in at the moment and remain optimistic. As news of the vaccines broke, some of the areas that were more economically sensitive and really struggled last year began to show signs of some recovery, particularly from November onwards. So we saw quite strong share price appreciations in energy companies, again, the airlines and retail companies I mentioned earlier that have come under significant pressure. And I think as the vaccine continues to be rolled out and we start to hopefully see some normality return, the share prices of those companies are likely to continue recovering. As far as we are concerned and what we're up to at Carrington, a lot of those sectors were already under structural challenges going into the pandemic. And I think it's fair to say the pandemic just simply accelerated a lot of those headwinds. And so thinking forwards, I think some of those sectors will probably continue to struggle and fall into decline, and therefore don't present good long-term opportunities, perhaps a good short-term opportunity. But I think some of those sectors, particularly in the financial area, such as banks, are more promising. And again, we'll come on to that a bit later on into their outlook. I know that we covered ESG in our last presentation, but I think it is really important to keep revisiting this, because I think it will be a really important theme for the next few years at least. So just very briefly, ESG, or otherwise known as environmental, social, and governance factors, are where fund managers will look at metrics of a company, but they will also now look at their metrics in terms of their environmental and social factors and combine those scores to give that company a sort of overall view, not from a financial perspective, but also from an ESG perspective. That's in the last couple of years, that has gained a lot of prominence because a lot of the public have now bought into this idea of sustainable investing and a more sustainable planet. Investors have also bought into that, and obviously the corporate world, which are probably the most important players in this, they have all bought into this story. And so we're now seeing a lot of momentum in this area. We will continue to see a lot of momentum for at least the next few years as the industry globally moves towards ESG investing. I think, again, mentioned last time that the natural sectors that this style or this approach leads you to are technology, healthcare, and renewable energy companies. They had already done pretty well going into the pandemic and did exceptionally well last year, as many of them were beneficiaries. And I think the reality is that they probably continue to do well in the years ahead, particularly with Joe Biden winning the presidency, because he's clear that he is all for green initiatives and very much against what Trump stood for. And so I think we're going to see a lot of investment in that area. Again, you probably have heard, but we do actually have a portfolio investing specifically in this theme. It's been running for a couple of years, and given the sectors that it has been exposed to, it won't be any surprise that it has done extremely well. Moving on to our themes for 2021. So from looking at previous commentaries that I've sent out, you would have seen us talk about themes quite a lot, and we have brought in some themes into the portfolios last year. Well, this year, fintech is one that stands out for us. We've done a lot of work in this, met lots of fund managers operating in this space, and it does look like an interesting opportunity for the long term. A lot of the traditional financials, and we've seen a lot of this last year during the pandemic, have come under pressure from smaller companies that are more technology orientated and are challenging the sort of traditional banking system. So I think that this is going to continue for probably at least the next decade or two. And the areas that we've looked at are not necessarily just about these sort of technology oriented tech companies. So when I say out with the old and in with the new, there are incumbents that are actually trying to fight back. So for example, JP Morgan has spent a lot of money trying to reposition themselves and maintain a position of being, a competitive position, so that they can sort of fight off this disruptive forces and emerge as one of the winners. So I think what you'll find is that some of the disruptive names will emerge as long-term winners, as well as some of the incumbents. And the strategy that we're trying to target has a bit of both. Infrastructure is another area that we are optimistic on. Again, we've probably mentioned this in the past. Again, by Joe Biden winning, clearly, he's talked a lot about infrastructure spending, and that's likely to increase, particularly because of the pandemic and the economic damage that's been incurred from that. So one method of trying to recover from this is to spend on infrastructure. And I think that's coupled with some of the sectors with infrastructure coming under pressure last year. So for example, energy infrastructure clearly came under a lot of pressure. Some areas such as toll roads were not used as much. And so this year, that sort of hopefully some normalization and recovery, economic recovery, we should start to see various aspects of infrastructure doing quite well. Healthcare is we are particularly excited about. And if we go back to my comment earlier about how quickly we developed a very effective vaccine against COVID-19, and that demonstrating the capabilities of the healthcare sector now, I think there's a lot of change going on in that particular sector. A lot of disruption again, and we've been speaking to Baillie Gifford, who are probably one of the world's leading asset management groups, who have been operating a fund offshore for the past few years, and they've only brought it to the UK market last month. We are really excited about their approach to this particular area. Now, if I mention the stock Moderna, clearly that's become a household name, given that they were one of the first companies to develop a vaccine against COVID. But 2 years ago, I think probably none of us had heard of Moderna. However, Baillie Gifford had already started making their very first investment into Moderna. The reason being was that they saw a lot of opportunity and potential in the technology and the platform that Moderna had created. Clearly, they had absolutely no idea what was coming with COVID, but they saw the potential and opportunity of that company. And clearly, they've done extremely well out of that company. And Baillie Gifford have done this time and again for many, many years, that they are very, very good at identifying those companies that have the potential to do well in the future. So there are a number of names in there, many of whom you probably never heard of, but we certainly believe that they have the potential to deliver very good returns in that particular sector. And given the sort of advancements in technology, I think that could potentially be the market leading sector. I know it's been technology over the past sort of decade or so, but I think there is a chance that healthcare could become the sector markets. So actions are, keep an eye on your inboxes. I will be writing out to people who are remain on our advisory service, talking about the changes that we'd like to be making in the portfolios and bringing in these themes. in summary, and sort of just for a high level portfolio thinking, we remain positive on equities for this year, largely because of the rollout of the vaccine and potential for economic recovery. And that coupled with, as I mentioned earlier, the central banks continuing to be very accommodative. Bonds, we are starting to see find a bit more difficult to invest in. Traditionally, bonds have been used in portfolios for diversification benefits. If you look at the UK 10-year gilt at the moment, that's got a yield of less than 0.3%. A good quality corporate bond will give you probably less than 1%. And if you go after some pretty risky bonds, you'll probably get something like 3 to maybe 4% in yield. So you're having to increase really dial up the risk in the bond space in order to try and achieve a relatively good return. And so we feel slightly uncomfortable about that part of the market, and therefore I've been looking at alternative sources of diversification. Many of you might recall that we invested in gold back in April 2019, and we remain optimistic on the outlook for gold. Another area that we've spent a lot of time on, perhaps the last 18 months, has been hedge funds. We have been slowly bringing in an increasing number of hedge funds, mainly for diversification purposes. And if we're comparing them to bonds, we see better potential returns from hedge funds relative to bonds over at least the next couple of years. And so, again, I think we'll be sort of slightly chipping away at our bond exposure where we have it, and buying hedge funds where we can. So that, I think I've just covered my position. So I think that brings us on to our Q&A session. I will just stop my screen. Here we go. Okay, so please feel free to ask as many questions as you like. Tommy, I think, will be reading them off for me.
Yeah, absolutely. So yeah, we've gotten some quite good questions actually already, which is good to see. So first of all, Mo, it's obviously, as you said, it's been a record year for government spending, fiscal policy, support, etc. And what do you think is the kind of right split for portfolios going into 2021? Thinking of the equity bond split, perhaps looking at growth versus value, and also looking UK versus more internationally.
Yeah, I think on the monetary policy front, I think that simply just tells us that equities are the best place to be relative to any other asset class. As far as exposures go, so I've touched on my thoughts on equities versus bonds. Growth versus value. So in the last 3 months, we have definitely seen value companies, so those that are slightly more economically sensitive, generally speaking, doing better. That's not to say, by the way, that growth-orientated companies such as technology companies have not done well. They have also done quite well since that period of time, but it's probably more neck and neck now. And some of the value areas are doing slightly better. So perhaps I'll say the banks specifically, and perhaps companies have been doing very well. So that's when I talk about themes for 2021. This is why I talk about fintech and why I talk about infrastructure, is because some of those will probably capture some of that and help to sort of balance out the portfolios a little bit. But I would say a more even balance between growth and value, rather than being sort of strongly tilted in any particular direction. And lastly, on the UK versus international, it's a slightly tricky one, and I think, and we've favoured smaller companies in the UK over any other part. But I think there is the potential for global asset allocators because no one's wanted to do it in the UK for several years now, given all the Brexit uncertainty. And so now that that's out of the way, there is a chance that you could start to see global asset allocators start to bring their UK allocation back to perhaps more of a neutral position rather than an underweight. So that could lead to a lot of flows into UK equity markets, and naturally they would go into the larger and mid-cap parts of the market. I think I think it could be a relatively good year for UK equities, which is why we're maintaining exposure, and the other parts that we have are under review.
Sure, brilliant. And going back to that kind of growth versus value argument, because obviously the year we've had with technology, people argue that valuations are very stretched at the moment. What's your view on kind of technology companies and their valuations currently?
I think it probably depends on which area of technology you are referring to, because there are so many subdivisions within technology now, and clearly some of those have done extremely well. So, for example, I think I would say the large tech businesses have actually, in the last 3 to 4 months, gone sideways. They haven't actually done much since late summer. So I would say the valuations in those companies are starting to normalize relative to their earnings. But other parts, yeah, clearly, there are some that have probably gone a bit too far. And so I think the key is to maintain a good level of diversification in the portfolio and across the technology sector. So if you're going to invest, I would be sort of as diversified as possible, trying to capture a range of themes rather than a couple of names.
Sure. Another question we had was, moving into a potentially stronger global recovery, hopefully the rest of the year, how do you think you'll tailor your portfolios?
Sorry, I missed the last part of that.
Sorry, how do you think you'll tailor the Carrington's portfolios in place of a stronger global recovery?
Yeah, so going back to my previous point about the themes we are looking at, for example, fintech and infrastructure, a lot of those have exposures to parts of the markets that are poised to do well. Actually, and it might be just worth mentioning that we actually do already have exposures within the portfolios that will capture that recovery anyway. We can see that in the returns of some of those funds this year, and I think parts of the emerging markets in Asia also fall into that camp. So we do actually already have a good level of exposure to those companies, and I think by bringing in some infrastructure and some fintech, that we will slightly enhance that to create more of a balanced approach.
Sure. And kind of along those lines as well, with Biden coming into presidency tomorrow, are we adapting the portfolios to kind of show a reflection on the sectors that might do well under his presidency? You touched on kind of ESG and the like.
Yeah. So infrastructure I've just mentioned, and he's been very keen and very vocal about that. Yeah, clearly sustainable investing, I think, is just going to take center stage again, given his policies. What we've been trying to do is to introduce some of those funds that we have in our dedicated portfolio, the sustainable growth portfolio, into our core strategies. So we have already done this in the middle of last year, and I think we have ambitions to continue doing that. So we'll be playing that through infrastructure. We will have some of those ESG related names already in the models, and we'll be looking to expand on that as the year progresses.
And do you see any areas, in the equity space that could see potential sell-off, as you touched on earlier, with given kind of stretched valuations?
I think these days, if you see a sell-off in any one part of the equity market, the likelihood is that the rest of the market will follow. Particularly, there's lots of people talking about the technology sector, and that's probably where we're going to see it. Again, I think it really comes down to some of the extreme valuations that we're seeing. So I guess the obvious one being Tesla and NIO, those sorts of electric vehicle type companies, and any associated businesses with those names, which have done exceptionally well, probably way too well, I would have thought. And so it's very possible that we will see a correction in that specific area, and that's unlikely to, I think, follow through into other parts of the markets. But yeah, the most likely, perhaps it will be areas of technology that will be the most likely area to correct in the short term. But I wouldn't see that as a long-term problem. I would see that as a sort of long-term opportunity.
Sure, brilliant. And one final question we've had from a couple of people is on a very hot topic at the moment, Bitcoin. Do you personally believe it's investable, and do you have any thoughts of potentially owning the asset in future?
I did think that we'll get a question on this, given what it's been up to recently. So very often, Bitcoin is compared to gold. People refer to it as a sort of digital gold. I think long term, ultimately, some digital currencies will become the norm. Whether that's Bitcoin or not, I don't think so. It'll probably be something else. But digital currencies will be the future, and so I think the likelihood is that Bitcoin will probably continue to increase in value, and if it is indeed closely tied to gold, which we think it probably is, we remain optimistic on gold. So I think the likelihood is that yes, Bitcoin will probably continue to go up, probably quite considerably. As far as an investment goes, unfortunately, or fortunately, I don't know, it depends on your position, but the FCA have actually taken a negative view on this, specifically for retail investors. And there were a number of ETFs that are investing in Bitcoin, and the FCA turned around and said basically that platforms can no longer provide access to retail investors. So whether we wanted to or not, we can't actually do it any longer, and that became effective, I think it was about 10 days ago. As an institutional investor, and I can see has mentioned Rafa. Rafa are an asset management company who invested in Bitcoin a few months ago. So as an institutional investor, yes, you can still invest in those products, but unfortunately, as a sort of retail investor, you can't. And so at the moment, it remains uninvestable for us. And I'd like to think that by having some gold exposure that we are in some way connected to that, but clearly we're not going to see some of the tailwinds but that are behind Bitcoin and other crypto assets.
Yeah, sure. And another question we just got in. So the recent Brexit trade deal that came in was obviously great for everyone to see finally after so many years, but it didn't include financial services. So, how do you see this developing, and do you think it will impact on London's role as a global financial hub?
I think there is a risk that it will impact London's role. It's no secret that some operations from various companies have already moved to European destinations. So I think at the moment it probably remains unclear as to exactly how it's going to pan out. And as I mentioned right at the beginning, that there's still a lot of grey areas to iron out, I think, despite the fact that they've signed a trade deal. But at the moment, I think short term, there is a risk to London's role. And it probably depend on the agreements that we can make with other parts of the world moving forwards.
Sure. And do you think that affects the UK as being part of a global portfolio? I know you touched on earlier how you think we might see increased flows back into the UK, but do you think that'll have a kind of negative effect longer term?
I think we have to remember that the UK market makes up less than 4% of world indices. So sort of globally speaking, we're kind of insignificant, really. And quite often what you would find is that people invest in the UK, more so in UK companies, because of a home bias. Having said that, I think the opportunity in UK equities, there is a potential opportunity there. I think it remains slightly unclear still, but it kind of depends on whether global asset allocators do indeed start to reallocate to the UK, given that a lot of the uncertainty has passed. So, yeah, I think on balance we'll probably have slightly more UK exposure than a sort of traditional global portfolio would have. But whether that would be a strategy, I think it's unknown for now. But short term, I think there are opportunities.
Sure. We've just had a couple of questions come in on the ESG focus as well. So, firstly, how do we, as kind of portfolio managers, how do we look to identify greenwashing when looking at ESG and impact funds?
Yep. So for our sustainable model so far, what I have been absolutely focused on is trying to invest with companies or asset managers that have demonstrated a long-term, a sort of long tenure in investing in ESG. So so for example, if we take 91 asset manager and their global environment fund, that team have been investing in that specific area that they look at for at least a decade, maybe 15 years. And that's quite a common theme that you will find in the funds that we typically invest in. If I contrast that to something like Fundsmith Equity, so we are holders of Fundsmith in our core portfolios, and you may or may not be aware that they did actually launch a sustainable option of the, I think it was 2 years ago. To me, that is not a viable investment option on an ESG from an ESG perspective, because for one, Terry Smith isn't really known for his ESG credentials, and secondly, the only difference between the Fundsmith Equity Fund and the ESG version is two companies. There's only two companies that are different. Otherwise, you're pretty much buying the same thing. So that, I'm sorry to say, to me is greenwashing, and I would avoid that kind of strategy. So hopefully that answers your question.
Yeah, sure. And just to add to that, when we're researching funds, we do, take a look at their specific investment process, and we ensure that, these funds do have a very thorough ESG process as well. So, and along those lines as well, active funds within the ESG space can be quite expensive at the moment. And as you said, we're seeing more and more of them crop up. Are we able to access the ESG theme through ETFs, given their flexibility and kind of lower price?
It is possible. It's definitely possible. I would say that the options are building all the time. There's new ETFs coming to market all the time, as you're probably not surprised to hear, because it is the thing in vogue at the moment. And so we do actually have a couple of ETFs in the sustainable growth portfolio, where we felt a very compelling reason to have it. So I would say it's not impossible. It can be done.
Yeah, sure. Brilliant. Well, those are all the questions we've had so far. If you have any more, please ask away while you can. But if not, we're happy to take any specific questions over email after the presentation when it's done.
Yeah. Brilliant. I think that's all. Thank you very much, everyone. Please feel free, as Tommy mentioned, to email me if you have any follow-up questions, or if you have any particularly technical questions. I'm more than happy to come back to you with an extensive answer. Thank you, everyone.
Thank you, guys.
Thank you. Take care.